What's up, guys? Welcome to another investing video, and this is actually the second part of a video. So hopefully you've watched the first part where I explain the core difference between debt and equity, and how, or maybe not necessarily how, but when you invest in the share market, that is actually part of or a type of equity investing. In this video, I'm going to explain how that actually works with the share market itself. Now I'm going to bore you first with an accounting formula, and this is not going to get too complicated, okay? So just bear with me. So what happens is in accounting, they actually write it like this, which is assets is equal to liabilities plus equity. Now, personally, I don't know why they actually express it like this. I think it actually makes more sense to use basic algebra and say that equity is equal to assets minus liabilities. So it's essentially how much something is worth, essentially. So to use a simple example, because hopefully this will make sense to most people, if you buy a house, and again I'm going to keep the numbers very simple, you might buy a house for $100,000, okay? And in order to, let's just ignore, agent fees and all that sort of stuff. But in order to do that, you might get a loan of $80,000, and you might invest, or you might put in $20,000 of your own cash. So this is pretty common arrangement. It's actually called a LVR, loan to value ratio. So you borrow $80,000, you put $20,000 into the property, and you buy a house. Now in this example, the loan is $80,000 and the asset is equal to $100,000, right? The asset being the house. So the equity in this house is $20,000, right? It's $100,000 asset minus $80,000 liability, which is $20,000 equity, okay? And that's why you pay $20,000 in cash, okay? So that is, cash is actually an asset as well. So once you purchase that property, you still have your loan of $80,000. You now have the house that's worth $100,000, but you don't actually have the $20,000 anymore because that's gone to the previous owner of the house. Now what you're actually doing here is a form of leverage. Now, I don't want to get too much into this, but if you think about it, you've actually put in $20,000 cash to buy a $100,000 property, okay? So now for argument's sake, let's say that in 5 years, and I'm just kind of making up numbers here, guys. Let's just say, now in theory, you would have paid part of the loan down, but you would have done that with your own cash. So let's just keep the example simple and say that our loan is still $80,000, but the property is actually worth, and again I'm keeping things simple, it's worth $200,000 because it's doubled in value in 5 years. Let's say you invested in a good area. Now, as you can see, now the equity of this house is actually a $200,000 property, which is the asset, minus the $80,000 loan, which gives you $120,000 in equity. Okay, so that's how much it's actually worth. Now, remember, you invested $20,000. So if you sold that house today, or in 5 years in the future, you sold it for $200,000, where you repay the $80,000 loan, you're left with $120,000 in cash. So you've made $120,000 from a $20,000 initial investment. Okay, so the point being is that hopefully you understand what equity actually is. In a very simple term, it's how much something is worth. As I said above, right? How much something is worth. So let's now have a look at the share market, because that's what we're here to actually talk about. Now, what actually happens with the share market is that, normally what will happen is the company starts off as a private company. Okay, so it's not listed on the share market, and people will go through various stages of funding, and you'll have angel investors, which I talked about in the previous video. So that's when you hear about people saying, oh, such and such was one of the early investors in Facebook. So that's when these angel investors would have looked at Facebook or whatever other company and said, oh, this is actually a good business idea. So they'll put cash into the business and get a stake in the ownership of that business. And that's why they might have put in, for argument's sake, $20 million for a 5% stake in that business, but that business now might be worth $100 billion. So now that 5% stake is worth $5 billion. But where I'm going with this is, let's assume now that, let's just keep it simple, that we have this business, right? And we want to make it a publicly listed company, right? And we put it on the share market. So what happens is it goes through a process called an IPO, which you may have heard this term. So that's an initial public offering. And what actually happens is investors put money into that business, and in return they get a stake in the business. For argument's sake, they might get 1% of the business, right? Or this guy, he might put in a bit more money, etc. And people get a certain stake in the business, right? So once that happens, then the shares are then traded on the share market. Okay, and you can buy and sell these shares every weekday or every trading day that the market is open. Now, what's important for the business in particular is that they only get the money at this point here, okay, the IPO. Because after the IPO, you're just buying and selling shares between other investors. I mean, you could be selling your shares to the guy next door. Okay, so this is kind of like a secondary market. So another example might be, let's say that you write a book and it gets published and it's sold in bookstores. If someone buys that book, then you get money for that sale. But if that person who bought the book then sells it to somebody secondhand, online or wherever, then you don't get any money for that as the person who's written the book, right? Because it's still just one copy of the book. So that's what's actually happening here. So the point is that people list on the people list on the share market to gain access to a word called, well, in very simple terms, money. In financial terms, it's often referred to as capital. Okay, so they can get capital, they can get money for that. So just like as I used the example in the previous video about the pizza shop owner, this is what the business owners do when they list on the share market. They get money or they sell a stake in their business to get the money. Now, often they will retain a stake in that business. It might be quite a large stake, it might be a relatively small stake, it might only be 5% or 10%. But they still own a very large percentage of that money or of that business. So, as an example, I think the Packers, who used to be the richest family in Australia. So James Packer, he owns, I think as of the time of this video, it's about 40% of Crown. So even though Crown is a listed company and you can buy and sell the shares on the share market, one person, or actually his investment company, owns 40% of the company. But still, he sold 60% of it. So by selling 60% of it, he was able to get a lot of money for it. But it's still advantageous to be listed on the share market because you still have access to capital. And the way that you have access to capital is that you can issue new shares. So you can do an equity raising. And so the number of shares can actually be increased on the share market. So they can just literally create shares out of thin air and just say, right, we're going to issue 1 million more shares of our business and we're going to sell it at, X dollars. People buy those shares. So in this case, it kind of functions similar to an IPO, except it's not an initial public offering. It's just something that happens later. So again, as the time of this video, we've recently been through or still going through the pandemic. So a lot of companies were put under financial stress, particularly a lot of travel companies. So they needed to raise money in order to keep their business going, to pay salaries, etc., etc. So they can do this by issuing new shares, and investors can then purchase those shares, that way the company raises more money. So that is why the share market exists. Just at a high level, at a fundamental core level, this is why the share market exists. And this is so when you go onto a stock exchange and you buy shares, this is what you're actually doing. You're buying a stake in the business, and what that is doing for the company itself is they can raise money, or they would have, if they're listed, they would have already raised money, and they can continue to access capital very easily and very quickly when they are listed on the share market. So I hope that made sense. Feel free to make any comments. If anything's unclear, I might do a follow-up video. But thanks for watching, and stick around for the next one.